Welcome back. We're getting ready to start segment 3 on chapter 4. And we've talked about so far some economic models. In the second segment, we've talked about the market for computers and the market for gasoline. Now we're going to spend a few minutes talking about the stock market. And stock market, I think it's somewhat of a unique animal. It's, I don't want to say, but it is to a certain extent highly regulated. It is a market with a lot of volatility. It's a market that most people don't have, I guess, a lack of information about. Because if you just watch the internet, watch TV, read the Wall Street Journal, actually, the Wall Street Journal is probably not that good of an example because the information there is somewhat dated by the time you get the newspaper, even if you get the electronic version of it, because the stock market informational flow is almost instantaneous. If I decide to purchase a share of stock today, I call my broker. My broker puts a buy order in for X number of shares. The request is agreed upon with the seller. I get my 100 shares for, say $15. That price is automatically reported to the market and built into the price of the stock. So it's an instantaneous flow of information. The downside of that flow of information is there is a huge amount of that information. So you really have to sort through the information to find that information that works best for you. But again, there's definitely not a lack of information in the stock market. And if you think about a stock market, most of the stock market is, and I think it surprises people, but most of the stock market is owned by households. It's individual buyers and sellers in the market. There is some institutional holdings, or there are some institutional holdings within the stock market, but a lot of it's just owned by you and me and others within small investors within the market. And the stock market's driven, and it's especially in the United States, it's market capitalism. And if you look at the markets across the world, a lot of it you find in areas where, if you remember, we talked about economies, you have the socialist on one end of the spectrum and the market capitalism on the other spectrum. It's driven by market capitalism. It's free market. And it's always looking at the factors of production. Again, you go back to labor, capital goods, natural resources, technology. And again, technology is more, not so much what some people think about technology. It's more about the technology that's driving the production process. And then you've got the entrepreneurial spirit that helps drive that technology and the improvements and efficiency improvements in the production process. So that's what individuals at the stock market are looking at. Sellers are looking at it, buyers are looking at it. Everybody trying to figure out what's going to happen, not only in the next 5 minutes, but by the end of the day, what's the market going to look like when it closes today? What's the market going to look like at the end of next month, or the next month, or the end of the year? So everybody's trying to balance the information they're receiving and how that's going to impact their decision to buy or sell within the stock market. I want to quickly just talk about, and they talk about it in the textbooks, business organizations. So you've got sole proprietor. You've got sole proprietor could be something as simple as the food truck that's selling corn dogs on the street corner. In rural America, you have a lot of sole proprietors that are healthcare professionals, doctors' offices, physical therapy, ancillary providers. You may even have a traveling doc but a lot of them are sole proprietors. They're in business for themselves. So, and then you go from the sole proprietor, you go to the partnership. And a partnership may be, basically it's more than one individual, could be 2 or 3 docs together, could be 2 or 3 food trucks working together, could be multiple restaurants working together. could be even hospitals working together. So there's more than one, and it's a partnership agreement. And what happens in a partnership agreement is, and with the sole proprietor also, is you are taxed on your personal income. So the profit on that sole proprietor goes, as I said, because you're a sole proprietor, you get it all. The profit goes to you. It's taxed as personal income, and you're liable for any issues if you go bankrupt or can't pay your bills. Same with the partnership, in that the profits on the partnership are divided up among the partners at the end of the year. It goes as their personal tax, and it's also, there is a liability issue on partnerships as with sole proprietors. The one that's kind of in between partnerships and corporations, and the book doesn't mention it, and I'm not sure why, it's an LLC. So it's limited liability, and it's a legal entity, step up from a partnership. The good thing about it is it limits the liability, that if you go bankrupt, your creditors can't go back at you. So it limits that liability, but at the same time, the income that's divided among those individuals in that limited liability, or the LLC, it comes back to them as personal income. Next step up is a corporation. You've got like an S Corp and a C Corp. Let's talk about C Corp first. So generally, greater than 100 shareholders, a lot of paperwork involved, a lot of legal entity that has to be around that corporation. And it also is a corporation because it limits your liability. But on a C Corp, you're taxed twice. So the corporation's profits, they're taxed at the corporation's level. They take and turn around and send the leftover profits down to the shareholders, and the shareholders, in the form of dividends, or if they sell some stock and it's tax on capital appreciation, they're also taxed as a personal tax. So tax twice, government loves it, get some revenue from two different sources. If it's an S Corp, you have the advantage of the limited liability, and you can have, I think it's less than 100 shareholders, but you're not taxed twice. With an S Corp, the profits are divided among the shareholders, and those profits go in as personal profits. So depending on how you want to set your business up, you decide which one of those routes you want to go. A couple of things to keep in mind. Most of the corporations trading on the New York Stock Exchange they are C Corps. And you have to be a designated C Corp if you ever want to go public. So if you ever want to generate an IPO, you have to be a C Corp to go public. Stock market, we want to talk just a little about the stock market just itself. So new stock is, when somebody does an IPO, it's an initial offering of stock, and it's considered new stock. And then there is also the secondary stock, or a secondary market, or the book actually refers to it as used stock. So it's not new stock that's been issued by a corporation. It's stock that's been traded theoretically multiple times. And that's what you're going to see a lot on the New York Stock Exchange. You see it on, a lot of your financial market. It's used stocks. It's being traded by individual investors, institutional investors, the buyers and sellers in the stock market. And basically, the stock market itself, as we talked about a market, it brings buyers and sellers together to buy and sell goods and services. In this case, it's shares of a corporation on the stock market. And as I talked about earlier, there's multiple ways you can use a broker, you can invest your money through a large clearinghouse. So there's several ways to get your stock, but it's going to go through one of the exchanges. It's going to trade on the floor, and then once buyers and sellers come together, it clears the market, and that's the equilibrium price, and that's the price you're going to pay for your stock. Let's talk about kind of the demand and supply in the stock market. it's given the flow of information, as I talked about earlier. Shares of stock in any given corporation typically move to equilibrium fairly quickly. So prices and quantities. On one side, you've got the buyers, and you've got buyers who, in utility, they're trying to optimize that utility. They have a willingness to secure a stock in a corporation and the willingness to pay for that. So that's kind of on the demand side. On the supply side, you've got the sellers that are they're motivated by self-interest, motivated by profit. Maybe they bought the stock at a lower price and there's been some capital appreciation, and they want to sell the stock because they need some money to finance other financial agreements. So you've got all of these buyers and sellers out there in the stock market, moving in different directions, processing all this data, trying to determine not only what the spot price should be, but what the future price on that stock market should be. Quickly, just talk about it. If a company does generate a profit, and earnings per share are the driver that most people want to talk about when they have the earnings calls. But if they do generate a profit, there's two things they can do. They can either keep some of the money and call it retained earnings, or they can pass it on to the shareholders as dividends. So if you remember, going back to the decisions that producers make, they're concerned with what to produce, concerned with how to produce it, concerned with for whom the product goes to. And the fourth thing, which I don't think the book talked about, is kind of the preservation. How is the company preserving resources to ensure that they can continue not only to secure their place in a given market economy, but how they can also kind of and push that production possibility curve out as they go forward in the future. They want to see economic growth. Economic growth is what's going to drive the price of the stock and what should drive future dividends for the shareholders. So that's that retained earnings. It goes into that preservation of resources so that they have the resources to continue to move forward. And as I talked about earlier, today's spot price is the price that markets are trading. I haven't looked at the market this morning, but let's say GM stock right now is trading at a price of, I don't know, $50 a share. That is the spot price. If you look at the futures price, that futures price at some point in the future may say, well, I think based on the information, based on movements and perception, and again, information and income and population, that GM stock maybe have a futures price somewhere down the road of like $60. So you've got a spot price of 50, you may have a futures price of 60, you could have a futures price of 40, depending on how everybody is processing that information. When they talk about capital appreciation and dividends, that's where you're getting taxed. You're getting taxed on the dividends, you're getting taxed on capital appreciation if you decide to sell any of your stock. And on the demand curve, the lower prices implies that most investors believe the future earnings justify the prices. And if you're looking at the supply curve, the higher prices, more investors believe the future earnings don't justify the prices. So that equilibrium price in the market is where you have the shares supplied. It's on the supply side, the shares supplied. They don't believe that the future justifies the price equals the shares demanded, who do believe that the price justifies the future outlook for that company. So it's where that supply and demand equilibrium price, that's going to clear the market for the shares of stock. And you talk about why do supply curves and demand curves shift. It's based again on asymmetric information. It's the uncertainty with the economy, uncertainty with inflation, uncertainty with unemployment or the employment growth. It's a perception of future. You've got, again, flooded with information, driving these perceptions of the future is what's going to drive the positioning and the shifts in the supply and demand curves on the stock market. And it's a change in future expectation of a company's future profits. New information drives prices. And if you go back to whether you're watching Fox Business or CNN or any of your financial networks, they are trying to, I don't want to say assist people, but they are providing information from perceived experts to try to help individual investors decipher the information that's flowing back and forth in the market. And again, it goes back to risk reward. How much risk are you willing to take in the stock market for the perceived rewards you're going to get, either in dividends or capital appreciation? If you're a less risky investor, you may have your money stored in a CD, and the CD rate, I don't know, today, let's say it's 4%. You may have your money in a money market account that's drawing some interest. You may have your money stashed under a mattress, which I'm not sure anybody does with inflation like it is, but everything is driven by your risk rewards, how you view the stock market. And again, stock market, to some extent, like the crude oil market, is extremely volatile. It's extremely volatile, and it's because of this flow of information, the uncertainty, the ambiguity of what's going to happen, both in the United States and globally around the world. And as new information drives prices, as supply goes to the left and demand goes to the right, you're going to get an increase in price, but you're not sure about the quantity. You've got to play with the supply and demand curves to figure out what the quantity is going to be. And if the supply shifts to the right and the demand shifts to the left, you're going to get a decrease in price. And again, you're going to have to kind of play around with the quantity. And that kind of wraps up the stock market again. Just remember, buyers and sellers, significant amount of information flowing in, extremely volatile market. You have to be comfortable with your risk and reward, but that's part of living in a capitalistic market, a free economy that allows prices and quantities to drive the market and help clear the market, that equilibrium price. That's going to wind up that third segment. As we move into some other segments in Chapter 4, we're going to get into some government interventions. And the first one we're going to talk about is price floors. And I'll be back in a few minutes and we'll get into detail about the price floors. Thanks for listening, and talk to you soon.